Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everybody, welcome to Daily News Simplified, an answer to what, why and how of newspaper reading. Today we shall be analyzing the Hindu newspaper dated 5th of May 2022 of the New Delhi edition. The topics to be discussed today have been presented on your screen. Timestamping for the same has been provided in the description box below. In continuation with our weekly series of mains assignment question from the Daily News Simplified videos, the question for this particular week here is, explain how the concurrent list has become a friction point for the center-state legislative relations and suggest some measures for the smooth functioning of the same. The answer to this particular question has to be written in 250 words. Now, before you write answer to this particular question, please go through the DNS dated 20th of April 2022, in which we have covered this particular topic. The first article appears on page number 1 as well as page number 6. This particular article is important mainly with respect to prelims under the subsection of Indian economy. Now, before I discuss this particular article in much greater detail, let me first give you the background. See, presently, in the month of March 2022, the CPI headline inflation has increased to almost around 7%. And as you know, that the Monetary Policy Committee is required to maintain the rate of inflation below 6%. So since the present rate of inflation has crossed the threshold, the Monetary Policy Committee has recently decided to increase the policy rates. Now the question is, why has there been an increase in rate of inflation in the Indian economy? This is on account of both global factors as well as the domestic factors. Coming to the global factors, now because of the Russia-Ukraine war and the consequent sanctions imposed on Russia, there has been increase in the global crude oil prices. Apart from that, there has been increase in global food prices because of the rising COVID infections in some of the countries and the consequent lockdowns imposed in these countries. There has been supply chain disruptions leading to a decrease in the supply of certain essential commodities. Now, when it comes to domestic factors, as you know, India imports more than 80% of its crude oil requirements. Accordingly, the higher crude oil prices has led to imported inflation as far as the Indian economy is concerned. Not just that, even the food prices have increased to more than 7%. The higher food inflation is on account of the higher edible oil prices. Even the non-volatile commodities also have seen a much higher increase in the rate of inflation. For example, if you look at the core inflation is now more than 6%. So we are facing inflation not just in terms of volatile commodities, but even in terms of the non-volatile commodities. So far the Monetary Policy Committee was maintaining a status quo as far as the repo rates is concerned. The Monetary Policy Committee earlier, it was of opinion that if the repo rate is increased, then the rate of interest on loans would become higher. And this can actually lead to decrease in the investment. So if the investment rate reduces, particularly when the Indian economy is facing a slowdown, this can have an adverse impact. And that is why, so far, the Monetary Policy Committee did not increase the repo rate. But now, the Monetary Policy Committee has changed its approach towards the inflation. Now, Monetary Policy Committee feels that if we allow the inflation rate to continue, then in the medium term, the high rate of inflation can actually lead to a decrease in the GDP growth rate. So now the Monetary Policy Committee has shifted its focus towards price stability, that is maintaining the rate of inflation. Accordingly, it has increased the repo rate from 4% to 4.40%. Further, the monetary policy corridor also stands changed now. For example, the marginal standing facility has been increased to 4.65% and the standing deposit facility has been increased to 4.15%. So these are the developments which have taken place and you must have read in the newspaper as well. The question is, in what way we can expect questions in the UPSC prelims examination? For that, you need to have a look at the previous year prelims questions. Now, if you have a look at the question which was asked in prelims 2020, the question was, if the RBI decides to adopt an expansionary monetary policy, which of the following would it not do? Similarly, in prelims 2017, there was a question related to the Monetary Policy Committee. Similarly, in prelims 2015, there was a question about management of inflation rates in India. So based upon the analysis of the previous year question papers, one can easily come to a conclusion that normally UPSC has been asking questions related to the monetary policy tools such as the repo rate, SLR, marginal standing facility. Similarly, UPSC has been asking questions related to management of inflation in India. Questions have also been asked with respect to monetary policy committee and so on. So keeping in mind the requirements of the UPSC prelims examination, one should be aware about the monetary policy committee, its mandate, roles, responsibilities, composition and so on. The monetary policy tools, that is repo, MSF and standing deposit facility, and the monetary policy corridor. So this standing deposit facility and the monetary policy corridor, that is a new modified monetary policy corridor, is quite important as far as your upcoming prelims examination is concerned, because these are the new developments which have taken place recently. Now, based upon our discussion, you should be in a position to attempt these 4 prelims questions for practice. So let us start our discussion with respect to the Monetary Policy Committee. See, the Monetary Policy Committee, it is actually a statutory body which has been set up under the RBI Act 1934. It has been set up based upon the recommendations of the Urjit Patel Committee. So what exactly is a mandate of the Monetary Policy Committee? See, the central government fixes the inflation target in terms of the consumer price index every 5 years. Right now, this inflation target which the MPC is required to maintain is between 2 to 6% and ideally at 4%. So ideally the CPI rate of inflation should be at 4%, and this CPI rate of inflation could vary between 2 to 6%. But the overall CPI rate of inflation should be in this particular band of 2 to 6%. So in order to keep this inflation within this particular target, the MPC takes certain decisions. So please do remember that the decisions which are taken by the Monetary Policy Committee, they are actually binding on the Reserve Bank of India. Now with respect to composition of MPC, MPC has totally 6 members, 3 members from RBI and 3 members from the government. The members from the RBI include the RBI Governor, who also acts as the chairperson of MPC, the Deputy Governor, and an official nominated by the Central Board of RBI. As far as the government is concerned, here the government is represented by 3 members. These 3 members are nominated by the central government, and they are nominated based upon a committee which is headed by the Cabinet Secretary. So a committee which is headed by Cabinet Secretary will recommend certain names to the central government, and from those names the central government will pick 3 members who will then become part of the Monetary Policy Committee. All of these 6 members, they enjoy a tenure of 4 years and they are not eligible for reappointment. Now, how does the Monetary Policy Committee makes decisions? See, the decisions of the Monetary Policy Committee, they are based upon majority and all decisions are taken through voting. It functions on the principle of 1 member, 1 vote. But as you can see here, it has an even number of members, that is, it has 6 members. So it can so happen that 3 members of MPC can take a decision in favor and 3 members may take a decision in against a particular proposal. So there could be a possibility that 3 members are in a favor and 3 members are against a particular proposal, and in that particular case it will lead to a tie or it will lead to a deadlock. So how to break this particular deadlock then? So in case of a tie or in case of a deadlock, the RBI Governor, who is also the chairperson, he will then cast his casting vote in order to break this particular deadlock. So as far as the RBI Governor is concerned, please remember here, first and foremost, this RBI Governor will exercise vote as a normal member of the Monetary Policy Committee. So if the majority is decided in a particular favor, then the decision would be taken. But if there is a tie, in case of a tie, the RBI Governor will then exercise a casting vote as a chairperson of the Monetary Policy Committee. As far as the meetings of the Monetary Policy Committee is concerned, the RBI Act 1934 provides that the MPC should meet at least 4 times in a year. But right now, the Monetary Policy Committee meets every 2 months. Further, in order to ensure the accountability of the RBI in order to control inflation, the RBI Act 1934 provides that RBI should submit monetary policy report to the central government every 6 months. Further, if the RBI is unable to meet the inflation target, that is, if the RBI is unable to keep the inflation between 2 to 6%, in that case, the RBI should present a report to the government explaining the reasons as to why it has failed to meet the inflation target. So both these two things have been incorporated in the RBI Act 1934 in order to ensure the accountability of the RBI towards the government. So based upon our discussion related to Monetary Policy Committee, look at the question which was asked in prelims 2017. The question was, which of the following statements are correct regarding the Monetary Policy Committee? First one, it decides the RBI's benchmark interest rate, which is correct. It is a 12-member body. As we discussed, this statement is wrong. It functions under the chairmanship of Union Finance Minister. This is also wrong because it functions under the chairmanship of the RBI Governor. Accordingly, the right answer to this particular question would be A only. Now coming to repo and the marginal standing facility. As most of you are aware, repo is basically a tool which is used by the Reserve Bank of India in order to inject liquidity into the economy. So in a way, repo rate is the rate at which banks borrow loans from the Reserve Bank of India. So what happens in case of repo is, let's say you have a particular bank and this bank is in need of money, let's say 100 rupees. So what this bank will then do here is, it will sell a government security worth rupees 100 to the Reserve Bank of India, and then it will borrow 100 rupees. So this is the first leg of the transaction. These repos as such can be of different durations. For example, we could have an overnight repo whose duration is for say 1 day. You could have 14-day repos. You could have 28 days repo. And now we even have long-term repos ranging from 1 to 3 years. So the maturity period of repo could be like 1 day, 14 days, 28 days, or even long-term repos whose maturity ranges from 1 to 3 years. So once the repo matures, in that case, in the second leg of the transaction, the bank here will repurchase the same government security which it had earlier sold to the Reserve Bank of India. So earlier it had sold this government security worth 100 to the RBI, right? So this same government security, this bank is repurchasing from the Reserve Bank of India. The rate at which this bank is repurchasing the government security, this itself we call it as the repo rate. So if you look at the repo here, repo's duration could range from 1 day to 3 years. As I said, now we have introduced even the long-term repos. So this particular transaction where the banks are borrowing money from the RBI, this transaction itself we call it as a repo. Now as far as the rate of interest on the repos is concerned, here either we can have a fixed rate repos or the variable rate repos. When we say fixed rate repo, it basically means that the rate of interest as such, it is equivalent to the prevailing repo rate. For example, now the prevailing repo rate is 4.40%. So if a bank is borrowing money from the RBI by selling the government securities, then the rate at which this particular bank will repurchase the government security will be equal to the prevailing repo rate, that is 4.40%. But on the other hand, let's say the rate of interest is a variable rate repo. So in this particular case, the rate of interest on the repo will be decided through an auction. So what normally happens is RBI will come out with a notification asking whether the banks need money. In that particular case, the banks will bid to borrow money from the RBI. So let's say you have A, B, C bank, and RBI has said that it is willing to pump in say 100 crores through the repo window. So here each of these banks will be required to bid as to how much interest they are willing to pay to the RBI. For example, bank A could say that it is willing to pay 4.5%, Bank B may say it is willing to pay 4.6% and Bank C may say that is willing to pay 4.7%. So as you can see, it is the Bank C which is actually giving the highest rate of interest to the RBI, or in a way it is the Bank C which is having the most need of money. So accordingly, the RBI will give this 100 crores to the Bank C which is willing to offer the high rate of interest. So as you can see here, this 4.7% is a rate at which the Bank C is borrowing money from the RBI. So here, this is not same as the prevailing repo rate. The prevailing repo rate is 4.40 and that is a fixed rate repo. But here, through the auction, the RBI has decided that the rate at which it will lend money to Bank C is 4.7, and this 4.7 will then become a variable rate repo. As far as the limits on repo is concerned, banks right now can borrow only up to 2% of their net demand and time liabilities. So if the total fixed deposits as well as demand deposits with the bank is say equal to rupees 100, in that particular case, a particular bank will be allowed to borrow only up to rupees 2 through the repo window. So as far as marginal standing facility is concerned, it is almost similar to repo. That is, even the MSF is a tool which the RBI uses in order to inject the liquidity into the economy. But there are certain important differences between MSF and repo. What are the important differences? See, first and foremost, as I said, the duration of repo may range from 1 day to 3 years. But as far as the duration of MSF is concerned, it is just 1 day, which means that MSF as such is used for borrowing for an overnight purpose for a period of 1 day. Further, the MSF, it is 25 basis points higher than repo. For example, right now the repo is 4.40% and accordingly the MSF would be like 4.65%. And then if you look at the maximum limit on repo, it is up to 2% of NDTL. Similarly, the maximum limit which the banks can borrow under the MSF window is up to 2% of NDTL. Earlier, the Reserve Bank of India had increased this particular maximum limit on the MSF to 3% of NDTL. But since December 2021, the limit has been brought down to 2% of NDTL. Apart from these differences, the most important difference between repo and MSF is with respect to which government securities can the banks use in order to borrow from the RBI. So here, if you look at the government securities with the banks can keep the government securities as part of SLR or outside the SLR. So as you can see, the banks are required to maintain SLR in the form of cash, gold and government securities. So apart from maintaining government securities as part of SLR, the banks can also maintain government securities outside SLR. So when a bank is borrowing money from the RBI under the repo window, it cannot use a government security which is part of SLR. The banks must compulsorily use only those government securities which are outside SLR. But when it comes to the MSF, but let's imagine a particular scenario where a particular bank does not has any government securities outside SLR, or a particular bank may have exceeded the limit of borrowing under the repo, that is 2% of NDTL, and let's say it wants to borrow money from the RBI. In that particular case, the bank here can borrow money from the RBI under the MSF window for a period of 1 day. So in that particular case, what would happen here is, since the bank does not has a government security outside SLR, the bank will use a government security which is part of SLR in order to borrow money from the Reserve Bank of India. So one of the most important difference between repo and MSF is, in case of repo, the banks use government security which is outside SLR, whereas in case of MSF, the banks are eligible to use the government securities which are part of SLR. Now coming to the concept of reverse repo and the standing deposit facility. I hope all of you must be knowing about the reverse repo. Reverse repo is basically a tool which the RBI uses in order to suck out excess liquidity from the economy. So what happens in case of reverse repo is, the banks can keep the surplus funds with the Reserve Bank of India. So whenever the banks keep the surplus funds, in return, the RBI keeps government securities as a collateral with the bank. So this particular reverse repo may have a maturity period of 1 day and up to 14 days. So once this reverse repo matures, the RBI here will repurchase the government security which it had earlier kept as a collateral with the bank. The rate at which the RBI is repurchasing this government securities from the bank, this itself we call it as a reverse repo. So overall, reverse repo is a tool which the RBI uses to suck out the excess liquidity. But the problem as far as the reverse repo is concerned, the ability of the RBI to suck out money from the economy is in turn dependent upon how much government securities the RBI has. If RBI wants to suck out say 1000 crores, then RBI should compulsorily have government securities worth 1000 crores. If RBI wants to suck out say 1 lakh crore, then RBI must compulsorily has government securities worth 1 lakh crore. So if the RBI does not has sufficient amount of government securities, then the RBI's ability to suck out money from the economy will be severely constrained. Now, for example, just look at what happened during demonetization. During demonetization, the RBI had to suck out huge amount of money from the economy, but then RBI did not had sufficient amount of government securities. So in order to handle such kind of circumstances, the Urjit Patel committee had recommended for the introduction of the standing deposit facility. So this standing deposit facility has been introduced through an amendment to the RBI Act 1934. Even though this has been provided in the RBI Act 1934, so far the Reserve Bank of India had not notified the operational details related to the standing deposit facility. So in a way, so far we are not using this particular instrument. But recently, in the month of April 2022, the RBI has finally notified the guidelines related to the operation of the standing deposit facility. And that is why this particular topic becomes important for your upcoming prelims examination. So as you can see, in case of standing deposit facility, government securities are not used as a collateral by the RBI. Banks will simply keep the surplus funds with the RBI, and once the standing deposit facility matures, which right now is for a period of 1 day, so at the end of the day, the RBI will repay the entire surplus funds which the bank has kept along with the interest. So this particular interest which the RBI is paying, this itself we call it as the standing deposit facility. So overall, if you look at the purpose behind reverse repo and MSF is same. Both of them are used for sucking out excess liquidity. But the difference here is, in case of reverse repo, the RBI provides government securities as a collateral. But in case of standing deposit facility, the government securities are not used as a collateral. When it comes to the maturity period of reverse repo could be overnight or up to 14 days. But as far as the standing deposit facility is concerned, right now, the maturity period is for a period of 1 day only. As far as its relationship with repo is concerned, the reverse repo is right now 115 basis points below repo. So as I said, the repo is 4.40%. So the reverse repo right now is 3.35%. On the other hand, the standing deposit facility is 25 basis points below repo, which means it is right now 4.15. So look at the standing deposit facility rate, it is 4.15, whereas the reverse repo is 3.35. So the standing deposit facility is higher than the reverse repo. The limits under the reverse repo is minimum 5 crores and there is no maximum limit. Standing deposit facility is concerned, the minimum limit is 1 crore and there is no maximum limit. Finally, coming to the monetary policy corridor. See, if you look at the earlier monetary policy corridor, what used to happen here was repo was placed in middle. 25 basis points higher, we used to have the marginal standing facility, and 65 basis points below, we used to have the fixed rate reverse repo. So if you look at the difference between repo and MSF, this was 25 basis points. But if you look at the difference between repo and reverse repo, this was 65 basis points. So difference between repo and the upper limit and difference between repo and the lower limit was not same. The difference between repo and upper limit was 25 basis points and difference between repo and the lower limit was 65 basis points. That is why this monetary policy corridor, which was in existence before, it was referred to as a symmetric monetary policy corridor. Overall, if you look at the difference between the upper limit, that is MSF, and the lower limit, that is a fixed rate reverse repo, this was 90 basis points. And if you look at the floor of the monetary policy corridor, this was actually the fixed rate reverse repo. But in the month of April 2022, the RBI has adopted a new monetary policy corridor. As per the new monetary policy corridor, as you can clearly see here, the fixed rate reverse repo has been replaced by the standing deposit facility as a new floor. The other things are remained same. And so we have repo in middle, and in the upper level we have the marginal standing facility. So now you have a look at difference between repo and MSF and repo and standing deposit facility. So now repo is 4.40%. Accordingly, MSF is 25 basis points higher at 4.65, and standing deposit facility is 25 basis points lower at 4.15%. So since the difference between repo and MSF and repo and standing deposit facility is same, we call the new monetary policy corridor to be symmetric monetary policy corridor. Now the difference between the upper limit and the lower limit in the corridor is 50 basis points. So what happens in case of monetary policy corridor here is RBI normally does not change the MSF or the standing deposit facility. The Monetary Policy Committee announces changes in the repo. For example, say the repo has been changed to 4.5%. So automatically what would happen here is MSF would automatically become 25 basis points higher, which means it will be like 4.75%, and standing deposit facility will be 25 basis points below, which means in this particular case it will be 4.25%. So whenever you make changes in repo, accordingly MSF and standing deposit facility would get adjusted. MSF would be 25 basis points higher than repo, and standing deposit facility will be 25 basis points below repo. So automatically MSF and standing deposit facility change with respect to changes in repo. So that is the concept of the monetary policy corridor. So based upon our discussion, you have these 4 practice questions. Please have a look at these 4 practice questions very carefully and then try to attempt these 4 practice questions. And let me know the answer in the comment section given below. Those of you who would want to have a detailed explanation to these 4 questions, please attempt the questions on the eLearn platform. In the eLearn platform, you will also get the correct answer along with the explanations. With this, let us now take up the next article. Now, this particular article appears on page number 1 of the text and context page. The article is titled as the status of GST compensation dues. This article shall be important mainly with respect to GS paper 3 under the subsection of Indian economy and various issues. Now, before I discuss this particular article in much greater detail, let us first discuss the background. See, earlier, both the center and the state government used to impose a number of indirect taxes. For example, the central government used to impose a central excise duty, additional excise duty, additional customs duty, service tax, central sales tax. Similarly, the state governments used to impose the value added tax, luxury tax, entry tax, octroi duty, and so on. So because of imposition of multiple taxes on the goods and services, we used to have a problem of cascading effect of tax on tax. Hence, in order to remove this cascading effect of tax on tax and to improve the indirect tax regime in case of India, we introduced the goods and service tax on 1st of July 2017. Now, prior to the introduction of GST, some of the state governments were reluctant to become part of GST. These state governments felt that if the value added tax, that is VAT, which is a major source of revenue for the state government, if this VAT becomes part of the GST, then the state government will have a loss in their revenue. So this was an apprehension of some of the state government. Hence, in order to encourage the states to become part of GST, the central government then proposed for what is referred to as the GST compensation mechanism. So as part of the GST compensation fund, the central government has promised the states that the GST revenues will increase by 14% year on year. And if they have any loss in their tax revenue, then whatever loss which they are having, that loss will be compensated to the center. The question is, from where will center get the money? The center will get this money by imposing what is referred to as the GST compensation cess. So whatever money the central government gets through the GST compensation cess, this goes into the GST compensation fund, and this particular fund will be in turn used to compensate the states for their loss in their tax revenue. Now what has happened here is, in the year 21-22, for this particular year, the central government has so far not paid the compensation dues of almost around 78,000 crores to the state government. So this particular delay on behalf of the central government to pay the compensation dues to the states has in turn created new federal tensions. For example, the central government has been asking the state government to reduce the value added tax on the petroleum products so that the rate of inflation in the Indian economy reduces. While on the other hand, the state governments have been saying that it is the center which has not paid them the compensation dues for the GST. And since the center has not paid the compensation dues, already their revenues are under strain. On top of that, if they reduce their value added tax on their petroleum products, this particular loss in their revenue will further be accentuated. Now, why is this topic important? As you can see, in UPSC Mains 2020, we had a direct question related to this particular aspect. The question was, explain the rationale behind the GST Compensation to States Act of 2017. How has the COVID-19 impacted the GST Compensation Fund and created new federal tensions? Hence, keeping in mind the requirement of the UPSC, that is both from the perspective of prelims as well as the mains examination, we'll first understand the working mechanism of GST compensation, and then we'll go into the details about the recent controversy over the GST compensation mechanism. So this is a flowchart which basically explains the entire GST compensation mechanism. So as I said earlier, the state governments were apprehensive that if GST is adopted, then it will lead to their loss in the tax revenue. Accordingly, the Parliament of India has passed the GST Compensation Cess Act. As per this particular act, the central government has given a commitment to the state government that their GST revenues will increase by 14% year on year when you compare it with the base year of 2015-16, to be more precise, 31st of March 2016. Now let's try to simplify these two aspects. Now let's say I take the state of Karnataka, and let's say as on 31st of March 2016, the overall revenue earned by Karnataka from the taxes which have now become part of GST, let's say it is equal to rupees 100. So let's say from all of these taxes which have become part of GST, the government of Karnataka as on 31st of March 2016 has earned rupees 100. So as I said, GST was introduced on 1st of July 2017. So as on 31st of March 2018, this GST revenue, this revenue of the state government should actually increase by 14%. So this should be 114. But please remember here, this is a commitment that the GST revenue will increase by 14% year on year, which means if you go to the next year, that is 31st of March 2019, and here we are saying that it should increase by 14%. So this 14% is not with respect to base year of 2015-16. Rather, it is with respect to the previous year. So previous year, GST revenue for the government of Karnataka was 114, right? So on this additional 14%, there should be an increase. Similarly, by end of 31st of March 2020, in comparison to the previous financial year, the GST's revenue should increase by 14%. So please remember here that the GST revenue that should increase by 14% year on year and not with respect to the base year. So this is a commitment which the central government has given. And this particular commitment is applicable for a period of 5 years. Very interestingly, this commitment is going to end on 30th of June 2022. What does this mean? This means that only until the end of 30th of June 2022, whatever loss the state governments are having with respect to the GST revenue, only until that the loss would be compensated. Beyond 30th June 2022, if the revenues of the state government do not increase, say by 14%, then the central government will not pay them any kind of compensation. So the central government has said that only for a period of 5 years, the revenue of the state government will increase by 14% year on year. And after 5 years, if their revenues do not increase, then the central government asset will not be under any kind of obligation to pay compensation to the state government. Please remember that this is the most important aspect. So here the central government has said that to compensate the state government for the loss in the revenue, the central government will impose the GST compensation cess. Right now, this GST compensation cess is imposed on certain harmful goods or sin goods, which include pan masala, tobacco, coal, motor vehicles, etc. And this cess rate as such, it ranges from as low as 15% to as high as 135%. You don't have to remember as to what is the cess rate on different products, but broadly you must remember that it ranges from 15 to 135%. So whatever money is collected through a GST compensation cess, initially all that money will go into the Consolidated Fund of India. From the Consolidated Fund of India, with the Parliament's approval, this money will go into a separate fund called as GST Compensation Fund. And please remember here that this GST Compensation Fund is actually part of Public Account of India. So the central government has said that whatever loss the state governments are facing, that loss they will compensate it every 2 months. The question is, what would happen to the surplus in the GST compensation fund? Now let's say for a particular financial year, let's say for the year 2019-20, you have a surplus in the GST compensation fund at the end of the financial year. Then what will happen to this particular surplus? Will the entire surplus be given to the states, or will the surplus be equally divided between central and the states? So here, as per the GST Compensation Cess Act, the GST Council may provide for 50:50 distribution of this surplus fund between the center and the states. For example, let's say by the end of the financial year 2019-20, we had 100 rupees in the form of the GST compensation fund, and this was a surplus amount. So here automatically it does not get transferred to center and states. So here the GST Council will pass a resolution that 50% of this amount will go to center and 50% will go to the states. So 50 rupees will go to center and 50 rupees will go to the state governments. So having understood as to how the GST compensation cess mechanism works, let us now look into the recent controversy. See, for the first 2 financial years, that is for the financial year 2017-18 and for the financial year 2018-19, for these 2 years, we do not have a problem as far as the GST compensation fund is concerned. So for these 2 years, we had a surplus in our GST compensation fund, and this particular surplus was in turn distributed between center and the states. The problem actually started from the year 2019-20, wherein the amount that we collected in the GST compensation fund, this amount was lower than the compensation amount which was to be paid to the state government. Now, for example, if you see for the financial year 2020-21, the amount that we collected in the GST compensation fund was lower than the amount that we had to pay to the state government for their loss in their tax revenue. Accordingly, for this year, that is 2020-21, the central government borrowed around 1.10 lakh crore, and this borrowed money was in turn used to compensate the states for their loss in the tax revenue in the year 2020-21. So here the central government has borrowed money. This borrowed money has to be repaid back along with the interest. The question is, how will we repay this borrowed money? Now, as I said, the GST compensation cess, right? This will be applicable only until 2022 and not beyond 2022. But here, the central government has borrowed money, and this borrowed money is required to be paid back along with the interest. So here, in order to repay these loans along with the interest, the central government said that we will extend the GST compensation cess. So earlier, the GST compensation cess was to be in existence only until June 30, 2022. But now the GST compensation cess has been extended until the end of 25-26. So we will continue to collect the GST compensation cess until 25-26, and whatever money that we are collecting here, that is the GST compensation cess, that tax money, we will use it to repay the loans along with the interest. So that is the basic idea behind extending the GST compensation cess. Now, recently, some of the state governments have started asking for a new demand. So what is that new demand? Now, as I said, the state governments have been guaranteed that their GST revenues will increase by 14% year on year, right from July 1st, 2017, that is when GST was introduced, to until June 30, 2022. So between this time frame, that is from July 1st, 2017 to June 30, 2022, the revenues of the state government will increase by 14% year on year, and if they don't increase by 14% year on year, we will compensate them. So this is the present mechanism. Now some of the state governments have been asking that this date, that is June 30, 2022, should be further extended at least until 25-26, which means that from July 1st, 2017 to end of say June 30, 2026, their revenues should increase by 14% year on year, and if they don't increase by 14% year on year, then the central government should compensate the states for their loss in their revenue. So basically, the state governments have been asking for this guaranteed compensation mechanism to be continued beyond 2022, ideally until the end of 25-26. So basically, now the state governments are asking, as it is, the central government is imposing the GST compensation cess to repay the loans along with the interest. This is what already the central government is doing. Apart from that, we must continue to impose this GST compensation cess even to compensate the loss in the tax revenue from 2022 to 25-26. So basically, the state governments want that if their revenues do not increase by 14% year on year from the year 22 to 26, whatever loss which they are incurring, that loss should be compensated by the central government. But this has been opposed by the central government. The central government has said that the states would get guaranteed compensation only until the end of June 30, 2022, which means that after June 30, 2022, if the GST revenues of the state government do not increase by 14% year on year, then there will be no obligation on the central government to compensate the states for their loss in the tax revenue. So as of now, the central government has said, look, we have extended the GST compensation cess, but whatever money that we are going to get from this GST compensation cess, that money we will use it only for repaying the loans along with the interest. This money we will not compensate the states for the loss in their tax revenue beyond 2022. So these are some of the important aspects which one should know as far as this particular article is concerned. With this, let us now take up the next article. The next article appears on page number 7. The article is titled as Inflation Control Needs Another Model. This article shall be important from the perspective of GS paper 3. See, we all know that the rate of inflation in a particular country can increase both on account of the demand pull factors and the cost push factors. In case of the demand pull factors, basically, these are the factors which lead to increase in the overall demand in a particular economy. So, in order to control the demand pull inflation, the Reserve Bank of India normally increases the policy rates, and by increasing the policy rates, the RBI can control the demand pull inflation. But as far as the authors of this particular article is concerned, the authors are highlighting that when it comes to the cost push inflation, the RBI's monetary policy may not be so effective in controlling the cost push inflation. And accordingly, the authors of this particular article have been highlighting that it is a government which should take measures in order to reduce the cost push inflation in an economy. Why is this particular topic important? As you can see in UPSC Mains 2019, we had got a direct question related to the inflation and GDP growth. The question was, do you agree with the view that the steady GDP growth and low inflation have left the Indian economy in good shape? Give reasons in support of your arguments. Apart from that, in prelims 2021, we had a direct questions related to what factors lead to the demand pull inflation. So let us try to understand as to what the authors are trying to say with respect to management of inflation in a country such as India. So as discussed before, the rate of inflation in a country can rise either on account of increase in demand or increase in the cost. So in the first case, we call this as demand pull inflation, and in the second case, we call this as cost push inflation. Now, what factors can actually lead to increase in demand in an economy? First and foremost, if the central bank of a country has been following expansionary monetary policy for a long span of time, such an expansionary monetary policy will obviously lead to increase in the money supply in an economy. So the increased money supply will in turn lead to the higher demand. Now, for example, when you look at the Indian economy, after the global financial crisis of 2008-9, the Reserve Bank of India had adopted the expansionary monetary policy to provide the stimulus to the Indian economy. But what happened is, in the year 2012-13, the rate of inflation in the Indian economy started increasing. Secondly, if the government of a particular country is following fiscal stimulus policies in order to pump in more amount of money into the economy, in the long span of time, this will obviously lead to increase in demand. Now, for example, if you look at the advanced economies, some of the advanced economies such as US, European Union, etc., they started following the fiscal stimulus policies in order to increase the money supply to deal with the slowdown caused with the COVID-19. And that is why the rate of inflation in countries such as US, European Union, etc. has increased to its highest level in the last 4 to 5 decades. Apart from that, an increase in income levels of the persons can also lead to increase in the demand. So whenever the inflation is taking place because of higher demand in an economy, both RBI as well as government can take certain corrective steps in order to reduce the inflation. For example, RBI will adopt contractionary monetary policy. As the name suggests, contractionary, here the RBI will try to contract or reduce the amount of money supply in an economy. And to do that, the RBI will increase the policy rates such as the repo rates. So as the repo rates increase, it will become more costlier for the banks to borrow loans from the Reserve Bank of India. So accordingly, banks would now be pressurized to increase the rate of interest on their deposits as well as loans. So as the rate of interest on deposits increase, now more number of people would be inclined to deposit their money with the banks. Similarly, as the rate of interest on the loans increases, less number of people will take the loans. Accordingly, RBI's contractionary monetary policy can lead to decrease in demand. On similar lines, in order to deal with inflation, the government will follow the fiscal consolidation policy. As part of fiscal consolidation policy, once again here, just like RBI, the government will try to suck out the excess money supply. And how will it do it? For example, the government will increase the direct taxes such as income tax, corporate tax, etc. So as the direct taxes are increased, people will pay more amount of taxes to the government and people will have less amount of money to buy goods and services. And that is how, by increasing the direct taxes, the government can control the inflation. Apart from that, the government will also reduce its expenditure. So this will in turn lead to decrease in the money supply. So overall, as part of fiscal consolidation policy, the government will try to reduce its fiscal deficit by increasing the tax collection and reducing the expenditure. So this is as far as the demand side inflation is concerned. Now let's say a particular country is facing the cost push inflation. Now the cost push inflation can take place either on account of increase in the cost of raw materials or on account of supply side bottlenecks in the agriculture. Now when it comes to the increase in cost of raw materials, for example, the global crude oil prices as such have been increasing because of the sanctions imposed on Russia and because of the supply side bottlenecks. So this increase in crude oil prices will in turn lead to a high rate of inflation in other sectors. Why is that? Because you must understand that crude oil as such is a necessary input for various industries. For example, the crude oil is used as a raw material in number of industries. Similarly, petroleum products are used in the transportation sector. So as the cost of petroleum products increase, the cost of transportation will also increase. Apart from that, some of you must also be aware that because of the global disruptions caused due to COVID-19, we are facing an acute shortage of semiconductors. So this acute shortage of semiconductors has in turn led to increase in the cost of various final goods. Similarly, when you look at our Indian agriculture, in the Indian agriculture also we have a number of supply side bottlenecks. For example, if you have a look at our production basket of Indian agriculture, that is what we are basically producing. The production basket of Indian agriculture is basically dominated by rice and wheat. Now, for example, on an annual basis, we produce more than 300 million tons of food grains. But most of these food grains are actually rice and wheat. There is less amount of emphasis on production of other commodities such as pulses, oil seeds. Now you must understand that these oil seeds are then converted into edible oils. Similarly, we also face what is referred to as protein based inflation. Now protein based inflation is basically the inflation that we see in various commodities such as egg, fish, meat, milk, pulses and so on. Now the reason as to why we face this kind of inflation, especially with respect to pulses, oil seeds and protein based foods, is because over a period of time people's consumption pattern has actually shifted from rice and wheat to more of say pulses, egg, fish, meat, milk and so on. In spite of shift in the consumption pattern of people from rice and wheat to other protein based foods, the agricultural basket, that is the production basket of Indian agriculture, is still dominated by rice and wheat. So most of the time what we find is a problem of supply side, particularly with respect to pulses, oil seeds, edible oils, egg, fish, meat, milk, pulses and so on. So because of these supply side bottlenecks, the prices of these agricultural commodities normally are on the higher side. So overall, the cost push inflation takes place because of lower supply of certain commodities. So here the authors are arguing that when it comes to cost push inflation, the RBI increasing the policy rates to control cost push inflation will have limited impact. The reason is, even if RBI increases the policy rates, then it will have a limited impact in controlling the rising petrol and diesel prices. Similarly, even if RBI increases the policy rates, it would have limited impact on controlling the prices of pulses, edible oils, protein based foods and so on. This is so because the prices of these commodities have increased not on account of excess demand, rather they have increased on account of decrease in their supply. So on account of RBI having a limited impact as far as controlling the cost push inflation is concerned, it is the government of India which should try to reduce the cost push inflation. The question is, how can the government reduce the cost push inflation, particularly when it is taking place on account of crude oil prices or on account of agricultural commodities? First and foremost, the government should reduce the indirect taxes that we pay on petrol and diesel. Most of you must be knowing that when you buy a petrol worth say rupees 100 per liter, out of this 100 rupees, 60%, that is rupees 60, it is actually paid in the form of indirect taxes, which include the indirect taxes which are imposed by both center as well as states. So higher indirect taxes on petrol and diesel will obviously lead to a high rate of inflation. So on one side, you have petroleum prices which are increasing, and on top of that, the government is imposing higher tax rates. So the higher tax rates by the government will lead to a higher rate of inflation. So ideally, both the center as well as states must reduce the indirect taxes on petrol and diesel to reduce their prices. Secondly, as I said, right now we are facing this food-based inflation because of supply-side bottlenecks, supply-side constraints, where the production basket of Indian agriculture has not got itself aligned with the consumption pattern of the people. On one hand, the consumption pattern of the people has shifted from rice and wheat to more of protein-based foods, but the production basket of Indian agriculture has still come to be dominated by rice and wheat. That is why, in order to handle this shift in consumption pattern of the people, we need to enhance the supply of these agricultural commodities. And the way to do this is to promote agricultural diversification. So rather than just producing more of rice and wheat, we must actually promote more of agricultural diversification. We must encourage the farmers to grow more fruits, vegetables, pulses, oil seeds, egg, fish, and so on. So this is what you must understand as far as this particular article is concerned. The next article appears on page number 7. The article is titled as The Worrying State of Press Freedom in India. Now this particular article is based upon the recently published World Press Freedom Index. So as far as your prelims examination is concerned, you just have to have an idea as to what is this index all about and which agency publishes this particular index. If you know these two things, that is more than sufficient. So the World Press Freedom Index is basically an index which measures the extent of freedom which is enjoyed by media in a particular country. This index is published by an international NGO known as the Reporters Without Borders. This NGO is based at Paris and it enjoys a consultative status with the United Nations as well as UNESCO. The World Press Freedom Index basically measures the extent of freedom enjoyed by media in terms of 5 important parameters, which include the political context, legal context, economic context, socio-cultural context, and safety. Political context basically means the ability of the journalist to work without any kind of political pressure, or the ability of the journalist to hold the government officials accountable. The legal context basically means to what extent the media is able to work without any kind of censorship, to what extent the media has been given access to information. Economic context means the ease with which media can carry out its business in a particular country. Socio-cultural context means the extent to which media can work without any kind of socio-cultural pressures. And lastly, safety is the safety of the people working in the media. To what extent they are able to work safely without any kind of bodily harm or without any kind of pressure. Now, as per the latest World Press Freedom Index 2022, India's position has dropped to 150 out of 180 countries. So these are some of the important aspects which one should know as far as this particular article is concerned. The next article appears on page number 1. The article is titled as Supreme Court to Look into the Sealed Cover Jurisprudence. Now, as far as the concept of sealed cover jurisprudence is concerned, I have already covered all the aspects in the DNS dated 8th of March 2022. As you can see in this particular DNS, I have covered as to what exactly do you mean by the sealed cover jurisprudence, what is the present legal framework for the sealed cover jurisprudence, when is it used, and what are the various problems and challenges. So in case if you have not gone through this particular DNS, please go through this particular DNS in order to understand all the aspects related to this particular article. The link to this particular DNS video has been provided in the description box below. With this, we have come to the end of today's discussion. Now let us have a look at the question for the day.